Now we're going to take a look at each of the submarkets and just a quick overview of each, and then we'll get to some issues that we're focused on watching throughout the rest of this year and into next year. Northern Manhattan, we see that the number of properties sold is on pace to be down about 20% this year, but 40% below where we were in 2014. 2013 and 2014, Northern Manhattan was the hottest market in the city by far. If we look at the dollar volume, we're on pace for over $3 billion this year. That's up 33% from last year and essentially flat from 2014. Price per square foot has achieved an all-time record of about $423 per square foot. That's up 12% from last year. If we look at the Bronx, we see that the number of properties sold is essentially flat, same as last year. Dollar volume down about 2%, and price per square foot up 18%. There's a lot of demand for properties in the Bronx as investors are looking for yield. So we're seeing upward pressure exerted on pricing in the Bronx. If we go to Brooklyn, the Brooklyn market is on fire and has been, but even in a market that's so strong, we see that the number of properties sold is down 13% from last year, down 17% from the peak in 14. The dollar volume essentially flat, but still, if you look at what's going on in Brooklyn, a lot of these last year, $8.5 billion, this year, $8.5 billion, a lot of that has to do with the quality of the product that is being built and sold in Brooklyn. The average transaction value in Brooklyn is a lot higher than it's ever been. That market has really taken off. And if we look at average price per square foot, we see that we're up 19% from last year. Again, indicative of the tremendous strength that we see in the Brooklyn submarket. We go out to Queens, we see similar dynamics. We're up about 6% from last year in terms of number of properties sold, but 15% below that 2014 peak. And I guess it's similar to what we saw in Victor's presentation, where 2014 was the year in which we had the greatest job growth period, and that's been slowing. It seems like that has highly correlated to what we're seeing with respect to activity in the investment sales market here. Dollar volume will set an all-time record in Queens this year. We're on pace for about $5 billion. That would be up about 25% from last year. And the average price per square foot, a new all-time record, $373. That's a 6% appreciation rate over last year's numbers. And then things we're going to look at moving forward, and 3 or 4 months ago I had these in a different order because they were in a different order of importance and priority. 3 things that we're going to look at that don't have all that much significance but still are important and we're going to keep an eye on. Number 1, fear versus greed. I talk about this a lot. The 2 main emotional motivators of folks in any market are fear and greed. The third is herd mentality. But what we're seeing in the fear versus greed dynamic is that fear is becoming more pervasive in the market. Investors are getting a little more cautious, lenders are getting a little more cautious. And so how fear versus greed is going to play out over the next year, 2 years, 3 years, we will see. Interest rates. Given what's happening with job creation, given what's happening with the economy, and Victor, I think to your point of the capacity of the GDP to grow by 1.8 is the average, there is that factor that after a recession, the rubber band snaps back a little bit. So I would argue that the 2% average GDP growth is actually less than we should have had coming out of such a deep recession. But with that type of GDP growth and job creation the way we have it, is really not a great incentive for interest rates to rise significantly, but there's really no capacity for rates to drop. So with rates and cap rates being highly correlated, it's important to keep an eye on that, and we're going to get back to interest rates in a second when we talk about fundamentals. Strength of the dollar is something we're looking at also. The dollar has gotten a lot stronger. I think the strength of the dollar is something that is really misinterpreted by a lot of folks in the marketplace. You always hear when the dollar is weak, people say, well, the market is, the weak dollar is great for the market because we're going to have all foreigners come over and visit New York. It's cheap to come here. They're going to come buy buildings here because the dollar's weak. I never bought that argument from an investment property perspective. The weak dollar doesn't do anything for a foreign investor. So you come here and it seems like you're buying an asset cheaply, but you're collecting your gross revenue in the weak dollar, your net income's in the weak dollar, you sell the property, your profit's in the weak dollar. So unless you believe that there's an arbitrage opportunity between what your currency is performing at relative to what's going to happen with the strength of the dollar, there's no incentive based on a weak or strong dollar to invest or not to invest. For apartments, it's different. If somebody wants to buy an apartment here, the fact that the dollar is weak could provide some motivation or incentive for them to do that. But the biggest impact of the weak dollar is on tourism. And you could make an argument that the reason that the New York City market came back as strongly and as sharply as it did out of the last recession was because of the weak dollar and because tourism really helped the city's economy come back. This year we'll have about 58 million tourists come to New York. Where do those tourists come from? Everybody thinks that all 58 million of those folks come from overseas. The fact is that only about 20% of the 58 million people are from outside the US. So what does the weak dollar do? The reason the weak dollar is great for tourism in New York is not only does it make it indeed cheap for foreigners to come to the US, but it makes it very, very expensive for Americans to travel outside the country. So instead of somebody from Iowa going to Italy or France, they decide to come to New York. So the weak dollar is great for tourism. The strong dollar that we have now is bad for tourism because it makes it less expensive for folks to travel internationally. So we've seen with Brexit that kind of exerted upward pressure on the strength of the dollar. We're going to keep an eye on that moving forward because it does impact the market in a fundamental way. The last two items, the tax reform. Again, this has been on the list when there was uncertainty about who was going to win the election. I think that was a little bit more of a concern. And the reason for the concern was that a lot of the rhetoric about what is going to happen with tax reform revolves around corporate tax rates and marginal tax rates. Those are things that the average American can relate to. Anybody who has a job knows they pay taxes, they care about what their rate is, but ask the average American about what a carried interest is, they're probably not going to know what the heck you're talking about. Right? Ask them what a depreciation schedule is. They're not going to know. 1031 exchange, if you're not in the industry, you probably don't know that much about those things. But when a politician is looking at trying to make headway on corporate rates and marginal rates, there are things that normally get thrown under the bus when you have to create some kind of a negotiation, some kind of compromise. So we were very concerned about depreciation schedules, about the fate of 1031 exchanges, about the fate of carried interest, how that was going to be taxed. But I think today, probably what we're going to see in a tax reform that will occur, I think carried interest probably are going to end up being taxed as ordinary income. And the perception is that is going to be targeted at Wall Street, but it really will have a significant impact on operators in the way they do business within the real estate community. You would think that 1031 exchanges, capital gains rates, and depreciation schedules are not going to be that impacted that much, but it will be interesting to see the way the new administration is going to try to implement some type of tax reform.